Joining us more now is Michael Brown from Pepperstone. Michael, good to catch up with you again. So just taking a look at what happened overnight on global markets, somewhat choppy there. Of course, the focus being on the latest inflation figures out of the States. How did you see it?
Yeah, well, very well. Good evening from London. Good morning to you guys down in Australia. It certainly has been a very, very choppy day indeed. I think this really just shows the lack of conviction that market participants have, and I think the reason for that, and we've seen plenty of competing forces today. Of course, the day started with what was potentially positive news in terms of trade, with the idea that President-elect Trump may be phasing in tariffs rather than sort of delivering them all in one big lump at the start of his presidency. We then had some of the optimism around that fade, and then we had a big boost from cooler than expected US PPI data, and then again that faded as the day progressed. And I think, as I said, that really just speaks to a lack of conviction among market participants. Nobody really wanting to add fresh longs into the market at the moment, particularly in terms of equities, and nobody really wanting to hold positions for particularly long either, given the bonanza of event risk that we have coming up. We've got US CPI tomorrow. We're right on the cusp of earnings season getting underway on Wall Street, and of course the spectre of inauguration day in the United States next Monday as well. So very much market participants focused on the short term side of things at the moment, I think.
Oh, all right, but I mean, particularly ahead of that event, the inauguration, as you say, do you feel as though perhaps market participants there really don't want to take any solid position at this point because there are just too many unknowns?
Yeah, absolutely. I mean, there is so much uncertainty out there at the moment, and we are getting plenty of sort of sources, stories, and reporting as to what the Trump administration might do. But I think the key word there is might. There is absolutely no certainty as to what Donald Trump is going to do when he comes into office, and I think really that's causing two market reactions. One is the general sort of apathy around conviction at the moment. No one really wants to do anything apart from position relatively flat into the inauguration next week and the first few days of the presidency. And secondly, because we have such a high degree of policy uncertainty, it is leading to the higher volatility across the board, whether that be equity or rates or in the foreign exchange space. And it is leading to these very, very choppy yo-yo like trading sessions, exactly as we've seen today.
Michael, what are you making of the US dollar at the moment? Did ease slightly, perhaps in response to that news, maybe that the Trump administration will phase in those tariffs, nonetheless does or has been reflecting that American exceptionalism?
Yeah, and I think, excuse me, I think that latter narrative is the one that I continue to buy into. I still like the dollar. I think the US exceptionalism theme is likely to continue from a growth perspective, at least through the bulk of 2025. And of course, the other supporting factor is the fact that the Fed are looking likely to take a much more hawkish approach than their G10 peers. I mean, the market curve is not pricing a Fed cut until September, which seems a little bit punchy, but you could easily argue a case for the Fed to be on hold throughout the first quarter of this year. The first quarter of this year being a period where you would expect other G10 central banks, like the Bank of England here in London, like the European Central Bank across the Channel, to continue moving back towards a more neutral policy setting. So I think those are two factors underpinning the dollar. And then you've got some haven demand and perhaps some hedging flows coming in as well as a result of that uncertainty that we just alluded to. So yeah, I'm still a big fan of the dollar against pretty much all G10 peers at the moment.
Michael, can you give us a sense of what's transpiring there in the UK? That clearly the government is under some pressure there, certainly as far as its fiscal measures are concerned.
Yeah, absolutely. I mean, we are in quite a pickle here in the UK at the moment, to put it politely. I think the market has really woken up to what is a very, very perilous fiscal situation here in the UK. If you think back to October, the Chancellor left very, very little headroom or space between the amount of borrowing that was planned and the amount of borrowing that is permitted under our fiscal rules here in the UK. Since October, we've obviously seen a broad sell off across fixed income. We've seen yields on government bonds rise across the world, but also more pertinent to the UK economy, we've had pretty much no economic growth of note. And when you combine those two factors together, it means that the headroom that was very narrow is now non-existent. It's pretty much been wiped out entirely. And as a result of that, we've got a fiscal event at the end of March. I think the market is really saying to Chancellor Rachel Reeves and the Treasury that we need to see a commitment to significant spending cuts or to significant tax hikes in order to balance the books before we see faith among market participants restored and we see this gilt sell-off become a little bit more orderly and perhaps even the market retrace. But of course, the issue with that is if you deliver significant spending cuts or if you deliver significant tax hikes, well, that's only going to be a further very, very stiff headwind for economic growth. So it's very much a catch-22 situation here in the UK with no easy or particularly optimistic resolution in sight at the moment.
And of course, inflation remains the bogeyman, doesn't it? Because we look to potentially Trump's policies there has been inflationary. Similarly, too, we're seeing that in the UK with oil prices not helping, are they? Because they're on the rise again.
Yeah, absolutely. And this is the other factor that I think participants are concerned about at the moment. You look at that sort of an environment, who would you want to ride to the rescue? Well, a more dovish Bank of England would be the ideal solution. But the economic backdrop does not allow the BOE to pivot dovishly at the moment, as you alluded to. Inflation risks are ever present here in the UK. The budget that I mentioned saw what's called national insurance here raised, so effectively the cost of employment has increased. That will be passed further along the value chain and result in higher prices. Sterling now trading at about 121 at the lows yesterday against the dollar. That fall in the pound is going to result in more inflation being imported, and of course higher oil prices as well, which is the last thing that the Bank of England need. And of course all of this is coming on top of inflation that was already very, very sticky. We've had services prices here in the UK rising by north of 5% on an annual basis since the middle of 2022. So when you put all of that together, there is a lot of pessimism out there around UK assets, but I think most of it is probably justified at this moment in time.